Welcome to The Foundry, where leaders are forged daily. Each week we investigate themes of leadership, entrepreneurship, and mindset with some of the greatest minds in real estate. And now, the data scientist of real estate, George Roberts.
Welcome back, passionate investing community. I have an important announcement for you. My book, Passionate Living Through Passive Investing, is scheduled for release October 22nd. And I want to say I appreciate all who have left a review on Amazon. It makes a huge difference. But however, today I want to make sure we focus on the focus of today's show, which is find your exit, find your strategy. And today I'm joined by Peter May and Ross Rubin to talk about Delaware Statutory Trusts. This is a great investing strategy that, in my opinion, provides some significant advantages over a standard syndication. And with that, I'd like to let our guests tell the story because they're the true experts. So with this, I'd like to welcome Ross and Peter. Welcome to the show.
Thanks, George.
Thank you, George. Happy to be on.
All right. Hey, I want to make sure we get through the legal aspects. So is there anything you want to tell our audience?
Absolutely, Brad. I need to read a couple of sentences because I have to read a couple of sentences. Investment advisory services offered through Alpha Star Capital Management, LLC, a SEC-registered investment advisor. SEC registration does not constitute an endorsement of the firm by the commission, nor does it indicate that the advisor has attained a particular level of skill or ability. Alpha Star Capital Management, LLC, and DST Sherpa are separate and independent entities.
Awesome. Well, yeah, compliance is important. So want to make sure that you had an opportunity to do that. Yeah, and I'm really happy to have you on because I know Delaware Statutory Trust, this is a very important topic. And I think it's something that even confuses seasoned syndicators. I mean, really, in essence, it is a type of syndication, but it's a very, very special type of syndication. You've got some advantages and some disadvantages, I would say, over some ordinary syndications. So I guess I'd like to turn it over to you, whoever would like to take the question. So what's the difference and who is this most relevant to? Who's your real audience?
So the Delaware Statutory Trust, the DST, that is a form of a 1031 like-kind exchange. So when an investor is selling one property and exiting into another property, a DST, a Delaware Statutory Trust, could be a solution for them. Primary difference, a DST is a passive investment vehicle, okay, that allows for that 1031 exchange protection of tax deferral that we all like as investors. So that is something that is a key critical piece here. So, the DSTs, they do allow cash investments, but primarily we see 1031 exchangers who are looking to retire from real estate, hence find your exit, find your strategy, as you see behind Peter in our logo there. It is an exit strategy, and it could serve in other purposes. For instance, when you're doing a 1031 exchange and you're exchanging, you sold the property for $1 million and the replacement property, let's say, is for whatever reason ends up being 900,000, you fall short by 100,000 on that exchange. Well, a DST can fill that hole so that you won't have to incur taxes on that 100,000 of what they call boot if you don't exchange it into property. So that is a little bit. Peter, do you want to fill in the blanks there with your commentary?
I think part of it is like you said, we call it the table scraps approach. You're selling from property one, going to property two, and you have some leftovers is number one. The other is the backstop. Is what if there's a wild pitch? Using baseball terms, you sell property one, you're ready to go into property two, but the deal goes south. So you have a choice. You either take the cash, pay the taxes, or as I like to say, live to fight another day. It may not be the best solution that you are looking for, but if you sell property one for $1 million and you don't have a replacement or it falls through, it's your choice. Would you rather invest in the DST or pay the taxes and sit on the cash? That's why it segues really into a nice situation that what we like to say is protect your transaction with a 1031 possibility. If you're
Exactly.
selling
So you
real
got to name
estate,
that as one of your potential avenues when you go and identify your, I'm missing the terminology, but you have to identify your replacement property.
Right.
correct. And we even encourage clients that are thinking of selling property, and we would say, well, what do you think of doing next? And well, I haven't decided. Maybe I'll keep the cash. And using a 1031 wrapper for our sister organization called 1031 Sherpa, by the way, same logo, same taglines as above, it buys you 45 days to think. So you're doing a $2 million deal, you're going to sell the building. You're kind of on the fence of what you want to do. By paying that small charge of $1,400 to couch it in a qualified intermediary, you've just bought 45 days to think, which is pretty valuable. And if you don't end up going the 1031 route, at least then you've had a chance to marshal your professionals, your tax attorney, your CPA, to figure out what the best deal is from a tax efficient standpoint.
And Peter is
Back up a little.
notating the 45 days because as we all know, the 45 days is the identification period that the IRS gives us in a 1031 exchange. So very important that those 45 days.
Yeah, awesome. And I think it's probably a good opportunity to back up a little bit. So I would hope everybody knows what a tax change is, why it makes such a difference. Obviously, deferring those taxes. Just imagine over years and years and years, you defer those taxes, you can enjoy a significantly greater cash flow from your investments because you can control a significantly larger amount of real estate by deferring those taxes. But for those who haven't heard about 1031 exchanges or who may not understand all the ins and outs, like the identification period, et cetera, give us a quick background on that.
Happy to jump in. So 1031 like-kind exchange has been around for about 100 years. It always gets debated during political times of should we get rid of it? Is it only for the wealthy? All of that. Most of the transactions are in the $300,000 to $3 million range. So it's family businesses, it's owner operators. And in simple terms, what it's saying is it's like a little bit of monopoly, trading Park Place for Baltic. Selling property number one, the proceeds go to a qualified intermediary, a QI, and this is critical. Can't touch the money, can't do anything. So it goes from buyer cuts the check, it goes to the qualified intermediary. There's a 45-day period that the replacement property needs to be identified. And if that 45th day happens on a weekend, doesn't matter. There's no rounding to the next Monday.
Yeah.
And then the qualified intermediary sends that $1 million to the replacement property seller. So if you're the individual, you're selling property one, but you want to buy property two, you sell property one, the money goes to the qualified intermediary. And then when you decide to buy property number two, which has to be identified in that 45-day window and completed within a 180-day window, then you're fine. And the qualified intermediary is the professional middle person.
And the fact of the matter is, we talk about deferring taxes. There's a couple of components there with taxes. Most people are familiar with capital gains. You bought it for 100,000 and you're selling it for, 20 years ago and you're selling it for $1 million, that $900,000 delta, that's your capital gain. So that's capital gains taxes. But then there's also the depreciation recapture. So you depreciate that property down, which gives you a benefit along the way because it shields your cash flow each year. However, the IRS, when you sell that property, they want part of that back, 25%. the tax for depreciation recapture. So you have that component plus the capital gains, plus if depending on your income level, the net interest income tax, Obamacare tax as it's sometimes referred to on top of it. So a lot of tax, and then state taxes, depending on the state you're located in. So you're deferring a lot of taxes potentially, and that's why the 1031 exchange is so popular. The DST is a form of a 1031 exchange. It is a passive, so you're going from usually from active ownership into passive ownership of a institutional quality type of property real estate, and that comes in many forms.
Absolutely. And, I think a lot of commercial real estate investors, I know we got a lot of those out in the audience, they think of cost segregation as the solution to your tax woes. And it is in the short term. In the short term, as long as you own the property, that cost seg will zero out a lot. And then, as you mentioned, there is that depreciation recapture. So there is a day of reckoning. And a lot of people will say, well, the solution then is just to put all that money into another syndication and we're going to do another cost seg. But, obviously not a complete solution. One of the things that I do like about the DST is my understanding is you really handle everything for the client. So if I wanted to do this myself, a 1031, that is to say, I can go find my own qualified intermediary. I can identify my own replacement properties. I can do all my due diligence, et cetera. But, this is truly a passive solution. Somebody who comes to you with, either the entire proceeds of the transaction. Again, ladies and gentlemen, remember what Ross said a minute ago, or was it Peter, that you never touch the funds if you're going to do a 1031, right? You get that QI ahead of time. The check goes directly to the QI. Don't make that mistake. That's probably got to be the number one mistake. You grab the funds and then you want to do your 1031, and it's already way too late. But anyway, getting back to the 1031, then you can just essentially pick from opportunities that you've vetted. Obviously, do your own due diligence, listeners, on that. But it's different, obviously, than going out and being an active investor and then having essentially to start from scratch.
Correct. That I think one of the ways that we look at a DST is it's a wealth protector, meaning you've made your money, you've got your gains. It is somewhat of a wealth creator because you are enjoying the increase in the value of the building going forward. You're receiving monthly cash flows. It's there. But I guess the question that we always ask individuals, no matter what level they are at, financially or age, is how do you retire from real estate? Everybody's building, and they get lots of information about their 401k, their IRA. When should I take Social Security? When should I do this and this? And we have run into a number of situations where somebody says, I'm 70 years old and I want to get out of this, or I could be in my 40s and have 10 properties. 2 of them are dogs because they're not always going to be A+++. Well, what do you do with the one that is only making a 1 or 2% return? And more importantly, it's sucking the time out of you because whether it's the property manager or the toilets, the taxes, all those kind of things. And so what we always ask people is, what's your action plan for your investment? You think about it, if it's stocks and bonds, oftentimes real estate professionals who are a little bit on the control side, that's okay. What's your action plan for your real estate? How are you going to get rid of it? Have you talked to your children about it? And let's say you're moving from one part of the country to another. Do you really want to be managing property from 2,000 miles away? So, like it says in the logo, find your exit, find your strategy. How do you retire from real estate? And then sit back and listen.
I like it. And I think the plan for all of us, I am an active investor. I'm also a passive investor too. And, I think a lot of us that are on the active side, we just pride ourselves on that. Like, hey, this is what we do. But, I would say that the idea, at least for me, is to get over more and more onto the passive side as soon as possible, to really enjoy life. Of course, that's one of the themes of my book. Can't stop talking about that. But I love what you mentioned a moment ago, Peter. The way I look at it is kind of a matter of offense versus defense. So you said, yeah, this is a great way to sort of, defend the wealth you have, but hey, it's also a wealth creation strategy. So maybe you can sort of help our listeners understand. I mean, I think we did talk a lot about the defense side of it, but there are some differences between this and perhaps some other passive investing strategies. Like, for example, if you wanted to invest in some deep value properties, some sort of extensive rehab. I mean, there's certain things you can't do with a Delaware Statutory Trust. So maybe you can help us understand that.
Yeah, so let me take that, and Peter, fill in the blanks as we go. So the DSTs they're brought to market by DST sponsors. There's probably 50 plus DST sponsors. Quite frankly, we work with only the top 6 or 7 from a due diligence perspective. And we take that very seriously in terms of due diligence, where we make sure that the sponsors that we work with have the track record, have the management expertise, have the balance sheet, have been there through different cycles, so that we feel confident that the DSTs that they're bringing to market are going to perform as they say they are going to perform, because they release this 300-page PPM, private placement memorandum, with all the details, and our team goes through that. And it takes a week or two to go through all of that, to vet all of it, discussions with the sponsors, etc., before we feel comfortable in making it available, or offering it to, or showing it to clients and investors, and as a recommended DST. And one of the other things I wanted to bring up is that DSTs, they are considered securitized real estate. It is a security. So as such, it's actually governed by the SEC. And the SEC says to the DST sponsors, okay, if you want to syndicate this, you need to syndicate it through licensed financial advisors. And that's where Peter and I come in, because we are a part of an RIA firm, and we go to market as DST Sherpa. So we are able to have that conversation with clients and investors and serve as a critical role. The Sherpa, we talked about what a DST is and what's a Sherpa, as your guide. So that's our role as as a guide for investors, for clients, to look at the different DSTs and evaluate them and see what makes the most sense. Or in some cases, we've talked people out of investing in a DST, depending on their facts and circumstances, and look at all of this from our 4-quadrant approach, which we can get into in a little bit.
I think a couple of the follow-up points is, well, Peter, Ross, when do you talk somebody out of a deal? Well, if they have that 1 building or 2 buildings, and that's the bulk of their estate. And so if you're going to need to buy that Maserati or go on that cruise or do something that is very liquid within the next couple of years, then this is really not for you. And it's deciding, and this gets into the planning aspect of it, as kind of like the logo. You got the building, you got the mountains, and you got that setting sun. So you're winding down in the 4th quarter. What are you doing? And if you need liquidity, or if you're a control person, if you're somebody that likes to call all the shots, it's kind of tough to go from a GP to an LP, because somebody else is saying, this is what we're going to do. The advantage on it is you're really getting into institutional property management. It's an Amazon warehouse. It's a large multifamily, or student housing is one of the big areas right now. And mostly with the D1 Southern schools, because everybody wants to have that hotel life. So what you're doing is you're saying, here's where I want to be for a portion of my assets. The place where we like to flip the script for the youngers, or the people like yourself, George, who are active developers, real estate acquirers, is understanding the DST and the 1031 may actually help you acquire more property. Because for every buyer, there's a seller that has a hot mess going on. And if you're trying to help this person, you really want to buy this property, but they're kind of stuck in their way because they say, well, I'll sell it to you, but I need to get 1.2 million, George. I don't need $1 million because I got to walk away with X dollars. And it allows you to step in and say, Mr. Seller, what if I could achieve a decent cash flow, monthly payments, and taking a load off your mind because you knew it was somebody that's in this business that has done billions of dollars. So that, I mean, it's not guaranteed, but it helps. Well, you now are helping solve your seller's problems while you're trying to buy it. And that puts you in a more of a consultative approach. And we've had success with helping people do that.
All right, great. So another thing that I notice about these DSTs is they really do tend to focus on, I know you just mentioned institutional grade assets. These tend to be the sort of class A assets. I would say that's probably a big advantage to this. You guys are not investing in things that don't cash flow, things that might be more speculative. This is something where somebody can just more or less expect with decent regularity a proper distribution.
Yeah, that's why due diligence is really high on our priority list, because you're right, George. These DSTs are up and running, cash flowing literally on day one, because the DST sponsors are going out, they're buying the property, that $100 million property or set of properties with their own balance sheet, and then they tack on some financing to make the deal complete, and then syndicating it through that process. But they are cash flowing there, and so an investor literally on day one of their investment starts accruing the cash flow. It gets paid out usually like the 15th of the following month. They start accruing that cash flow day one, and yeah, our focus is really on those that provide that steady cash flow and continuous. To date, we haven't had one where the cash flow has stopped, which is good, and that just goes to the conservative nature of our philosophy and finding the DSTs and the properties that we think are, as Peter pointed out, more of a wealth protector first and foremost.
Yeah. Absolutely, absolutely. I mean, if you're out there trying to make a killing in real estate, doing something more speculative, maybe that's not the first choice I would have on my list, but for preserving the wealth and keeping you safe from taxation, getting a great, essentially a coupon while you're growing your wealth, absolutely. I think very, very cool. But, here's one thing we haven't really discussed yet. It's not really the only way that you can go. There's another structure called the tenants in common. Used to be more popular than the DST. DST really took over. I think it's been since about the last 2 decades. Maybe you can tell us some of the problems that existed with the TIC structure and why DSTs have really grown in stature since then.
Great question. So way back when, you had the tenants in common, otherwise known as the TIC structure. And there still are people that use that structure today and do that kind of combination. There's nothing wrong with it. The challenge came to be where if you're in a TIC with 15 other people, decisions have to be unanimous. And you got to track down the people, you've got to coordinate that. Now, if it's just me and Ross and George, and we live down the street from each other, getting some wet signatures isn't really that big of a deal. And if the three of us have known each other since we were, not sporting gray hair, that's easy to do. What happened is it got more and more complicated. And so people were looking for a solution, and the DST was a solution back in 2004, where a group of smart people got together and went in front of the Internal Revenue Service and obtained a revenue ruling, specifically 2004-86, and it says if you meet some of these guidelines, this property will qualify as a fractional ownership of a building, 2.3, 2.7, all those things. A lot of times people confuse it with a REIT, and that happens because, you own a share of a company that owns the building. And unfortunately, if you sell out of the building and go into a REIT, you got to pay the tax man before you can go in. Similar concept, meaning a person's running it. It's just the structure is very different. So if you think of a DST, Delaware Statutory Trust, think of it as a single purpose trust for this one transaction. And in 4 to 6 years, when it rolls out and sells, the advantage at that time is if you want to take a little off the table because maybe you're in a lower tax bracket, you have other things going on, then you can pay the tax maybe at a lower bracket if that's what you're in. We recently had a client that came to us, sold a building, and I'm doing rough numbers, for about $900,000. And because they researched with their CPA, they had $300,000 of passive activity losses that had been carried forward because the client had a large W-2. In effect, they could have taken $300,000 off the table without incurring taxes on that boot. Those are the kind of things that we drill into so that the client knows they're in the best position.
Yeah, I love it. A lot of things that I want to dig into there. Yeah, a lot of people might see it as like a REIT because it is totally passive. But
Right.
first of all, obviously not publicly traded. You have to sort of be plugged in. You got to know somebody to kind of get into the business, which is why we have this show here. I love educating people. I think that's very important. Well, I love it. And thanks for the philosophy on the ride out. I think it is very important. We're all about education over here. I want to thank you both, Ross, Peter. Thank you so much for taking the time to share your knowledge and experience with our audience. And we'll definitely pass that along. We'll find that all in the show notes. So if you're driving right now, I hope you didn't drive off the road trying to copy down that email address. That'll definitely be in the show notes when you arrive at your destination. So thank you both for taking the time. And, hey, look forward to seeing a lot of people in the future, hopefully saving on those taxes and living a better future.
Thanks,
Thank
George.
you very
This is
much,
great.
George.
Right. Thank you.